Good evening, everyone, and welcome back to the Natural Gas Engineering Internship at Petro. I hope all of you good and safe in these unusual times. My name is Rahima Babayeva, and I'm a fresh graduate from University of Aberdeen. I have finished my Master of Science in Petroleum Engineering, and I'm going to be a moderator for today's session on behalf of Arab Oil and Gas Academy. I would like to welcome you to the sixth session of Natural Gas Engineering Internship. This webinar is going to be about asset evaluation for gas condensate wells given by Dr. Alireza Haghighat. He's a senior technical advisor and trainer for engineering solutions at IHS Market. He's a trainer for reservoir forecast and can provide support for well test and optimize. Prior to joining IHS Market, he was a senior reservoir engineer at Eclipse Montage Resources for almost 5 years. As a reservoir engineer, he was involved in rate transit analysis of unconventional assets, asset development, hydraulic fracture and reservoir simulation, well performance evaluation with data analytics, defect analysis, and reserve evaluation. Alireza had been adjunct faculty at Pennsylvania State University since 2015, teaching courses in petroleum engineering, energy, business, and finance departments. He received PhD in petroleum and natural gas engineering from West Virginia University and master's degree in petroleum engineering from Delft University of Technology. Now let's move on. By the way, you can ask your question from QA part, and 3 or 5 questions will be answered by Dr. Haghighat. Now let's welcome together Dr. Haghighat. Dr. Alireza Haghighat, we are delighted to be here today. Now, it's yours.
Thank you so much, Rahima, for your introduction. Good morning, good afternoon, and good evening to all the students and participants of this session. As Rahima mentioned, I'm Alireza Haghighat, Senior Technical Advisor at IHS Market, and today we are going to talk about asset evaluation for gas condensate wells. So the objective of this session is to understand how we are going to assess, how we are going to evaluate a region, including multiple wells, and come up with some sort of prediction for the new wells and hopefully a development plan. So before we move through this asset evaluation session, I'm going to give you a little bit of background about, different type of asset evaluations into the oil and gas industry. So before we move forward, let's talk a little bit about, reservoir engineering and reservoir engineers and what they do in the oil and gas industry, because as a petroleum engineering graduate, you either end up in a reservoir engineering department for an oil and gas company, or you will be dealing with reservoir engineers. If you are a production engineer, drilling engineer, completion engineer, you should communicate with reservoir engineers. So it's very important to know what a reservoir engineer does in a company. So based on Schlumberger definition, reservoir engineer tries to increase hydrocarbon production, and more importantly, he or she maximizes exploration and production assets. So this is the job of a reservoir engineer. So let's talk a little bit in more detail about the tasks of a reservoir engineer, what they do, what are their jobs. So the first thing that reservoir engineers do is reserve evaluation. What do we mean by reserve? So reserve means how much recoverable hydrocarbon a company owns, how much recoverable hydrocarbon a region has. And besides that, based on that recoverable hydrocarbon, how much money the company is going to gain. So we are dealing with, some volumes of oil, gas, and the, value of those volumes. So reservoir engineer need to determine the reserves. How million barrels of oil a company owns, or how TCF of gas a company has. And at the end, how much money they are going to make. When they are done with reserve determination, how much reserve a company owns, they go to the second part, which is called evaluation. So if you are dealing with many wells in your asset, you need to have a good understanding of that asset. For example, you are dealing with good wells or poor wells. You need to understand why a well is good, why a well has very high production, and vice versa, why a well is poor. So your job as a reservoir engineer would be asset evaluation, to identify the reasons that why each region or what each well is behaving in a specific manner. Why this is important? Because at the end of the day, as an engineer, petroleum engineer, you should decide, you should optimize your future plans. You need to drill a new well, you need to design a new well, you need to decide how you are going to manage a well, how you are going to manage your production. So this decision making is very important and is made on best asset evaluation. So if you have a good understanding of your asset, of your wells, you will be able to make very good decision. And in oil and gas industry, these decisions costs millions of dollars and they can bring millions or billions of dollars into the company. So they are very, very important decisions. So let's look at different techniques that exist in the oil and gas industry for reservoir evaluation, for asset evaluation. So the first technique is called decline curve analysis. And we are going to review that in more detail because our main focus in this session is decline curve analysis. So what we do in decline curve analysis, we are looking at production data versus time. We fit a curve and we extrapolate that curve and forecast the production. Regarding to the reserve evaluation, the total production of a well is considered as the well's reserve. So this is how we determine the reserve, and we call it EUR, or estimated ultimate recovery. So this is the first job of a reservoir engineer, to forecast the production of the well and then come up with the reserve value. How they can do that? With decline curve analysis. And decline curve analysis is very easy. You just need to have your production data versus time. You fit a curve, and when you are happy with the curve, you extrapolate that and you forecast the performance of the well in the future. So decline curve analysis is very easy. As you can see, I show you, and it's very fast. So that's why it's very convenient for oil and gas industry to use it every day. Probably every engineer uses, decline curve analysis in their reservoir engineering department. And besides that, besides the fact that it's easy and fast, there is no need for additional information, additional data. You don't need to have geology information, completion information, your PVT, that's it, just production data. However, it has some drawbacks. If you want to perform some what-if analysis, you cannot do it with decline curve analysis. Let me tell you what I mean by what-if analysis. For example, what happens if you change your tubing size? What happens if you start injecting into the reservoir? What happens if you change your completion design? You cannot answer these questions with decline curve analysis. And as I will explain later, there is sometimes there is uncertainty in decline curve analysis. You need to consider probabilistic study to understand these uncertainties. With decline curve analysis, you cannot do that. The next technique that people use in oil and gas industry to evaluate an asset or understand the well performance is reservoir simulation. So in order to model your well and forecast the production, you can make a model for the well in the simulator and then forecast that, well performance with the simulation that you made. However, let's talk a little bit in detail about this process. In order to make a reservoir simulation, you need to have a lot of data. You need to have detailed geology, detailed completion, PVT, core, log, a lot of input parameters. So these are expensive and time consuming. Besides that, you need to have sometimes, expensive software. You need to have experienced people. You need to have enough time. These building and history matching these models is time consuming. So you need to have manpower and time. So this makes this process a little bit, impractical for some occasions, However, if you want to have a detailed evaluation, if you want to have a reliable answer to some of the questions that you have about your assets, about what-if analysis, you should have a reservoir simulator. For example, if you want to change the distance between the wells or change the well spacing, what happens? You should have a reservoir simulator. What happens if you want to inject, for example, water here and produce oil and water in the other side? You should have reservoir simulator. This is the most sophisticated technique in order to evaluate an asset. However, it's time consuming. It needs a lot of data, manpower, and money. So let's see what other technique people can do nowadays in the oil and gas industry to perform asset evaluation. So nowadays, you see data mining, artificial intelligence, machine learning is gaining a lot of popularity in oil and gas industry. So you can utilize the power of machine learning and artificial intelligence to evaluate your asset. This is now very practical, is getting very practical. Why? Because data is becoming more and more available. So the main building block for using artificial intelligence and machine learning to evaluate the asset is data. You need to have well data. And for well data, you need to have a lot of attributes, well information, sensors, gauges, more number of wells. All of these things are providing you with terabytes of data. And then if you know how to implement machine learning, you'll be able to evaluate your asset. You'll be able to understand, what's going on in your asset, and then you can make the best decision. So this is a new subject, and the good thing about machine learning is despite reservoir simulator, the development time for building a data-driven model is much shorter. It is able to analyze complex systems. If you are dealing with unconventional regions that typically show a lot of complexity in the nature, you can model them with machine learning. You can perform probabilistic study. You can perform what-if analysis. However, as I mentioned, you need to have enough data. You need to have at least, 50 wells with decent amount of production history, so you can train some data-driven, models and then evaluate your asset. And finally, the other technique which a lot of oil and gas people are using, it is called production data analysis or rate transient analysis. So in rate transient analysis, what you do, let me talk a little bit about, well testing. We covered that topic last week, but I talk about it more now. In the well testing, what you do, you understand, you evaluate your well, and you want to characterize your well. What is the permeability of my well? What is the drainage area of my well? What is the skin factor of the formation near the well? So all of these things can be defined by well test. How well test works, typically it's a build-up test. You shut in the well, you measure the pressure, you analyze the pressure, and then you can come up with those properties. With rate transient analysis, which is very similar to well testing in math and concept, is you analyze both rate and pressure together. So pressure is a signal of your reservoir. If you receive that signal and analyze it, you can characterize your reservoir and you can understand your reservoir characteristics. What is the permeability of my well or formation? What is the drainage area of my well? How much the well is draining? All of these things can help you to understand your well and reservoir. With rate transient analysis, you analyze both rate and pressure together with some different techniques, and then you can characterize your system of well and reservoir. And then the good thing about rate transient analysis is, despite reservoir simulation and modeling, you don't need to have complex models or detailed geological model. Simplified geology is okay for you. You need to have completion and PVT information. So despite decline curve analysis, which just relies on production data, now you are looking at actual physics of fluid flow in the porous media. And then you can perform what-if analysis, you can perform probabilistic study. It is fast compared with reservoir simulation and modeling that takes weeks to months to be completed. Here you can spend hours to perform rate transient analysis, and it is much easier compared with some of the techniques that we told you. So to make this introduction short, there are 4 techniques in the oil and gas industry for asset evaluation: decline curve analysis, reservoir simulation, data mining and artificial intelligence, and production data analysis. And today we are going to mainly talk about decline curve analysis. Okay, we will use decline curve analysis for asset evaluation. In next week, there will be another topic about, rate transient analysis. And hopefully in near future, we will talk about, data mining and artificial intelligence and how you can do that. So all of these techniques would be covered during, today or upcoming presentations. But now, since we are going to use decline curve analysis for asset evaluation, let's talk a little bit about decline curve analysis. So decline curve analysis, let me again explain it, what we do. In order to use decline curve analysis, the goal is to forecast the well performance and understand how much totally the well is going to produce throughout its life. So what we have here, we have production data versus time. Our job is to create a curve that fits through this data. Okay, this is the curve, this is, or maybe a line, this is a relationship or a correlation that goes into these data. We want to have the best fit. When we are happy with this fit, we are able to extrapolate it and forecast the well performance. So this is decline curve analysis. You need to make a fit through these data, through this production data. When you are happy with the quality of the fit, that's a reliable fit, you can use it for your forecast. So we are going to forecast the production in the future by making a nice fit through this data. And I'll talk about how you make this fit. There is one main assumption in decline curve analysis, and the assumption is whatever process that occurred in the past should continue in the future regarding to the fluid flow in the porous media and production operation. For example, if you are not injecting any gas in your well and you are going to inject gas in the future, you are not able to use decline curve analysis. So whatever happened in the past should remain the same in the future. If you are going to change anything, you cannot use decline curve analysis. So that's why you are not able to use what-if analysis with decline curve analysis. So there are 2 types of decline curve analysis. One is, you plot production rate versus time and make a fit. And the second, you plot rate versus cumulative production and make a fit. And I will show you that. So when the data that you have doesn't have very good quality or doesn't have high frequency, sometimes people recommend to plot rate versus cumulative or cumulative versus time, something like that. So this is the assumption. And the other thing is, if you have a lot of shut-ins, if you shut in the well and again you bring it back 2 months later, 3 months later, again you shut in the well, people recommend to have rate versus cumulative to get rid of that, shut-in periods. In decline curve analysis, we are dealing with 2 important parameters. The first thing, we want to characterize the decline of production rate. We want to know how that decline behaves. The first thing that we need to define is the decline, how the production decreases versus time. That's important. That decline should be defined, because we are going to analyze that decline. This is called, decline curve analysis. So the most important thing is to understand what decline is and how decline behaves. So the decline definition is very easy. It tells you how much change in the production we see over a period of time. Imagine last month, the production of a well was 100 barrels per day, and today the production of the well is 90 barrels per day. So how much decline we are experiencing? So from 100 to 90, 10 barrels per day, we see the decline in the rate. And then we divide that 10 barrels to the initial rate, and we call it 10% decline we are experiencing. So that's very easy. How much production drop we are experiencing in a specified time period. This is called decline, and you can see the math related to the decline here. So the changes in the rate divided by changes in the time, and then since we want to typically report it in a percentage, we divide that, production drop by the initial rate to report the decline by percentage. The production is declining in, by 10%, by 15%, by 20% over this period of time. But the question here is the decline rate constant, or is it changing as a function of time? Over this month, imagine the production rate declined 10%. Will it be constant throughout all of these times, 10%, or no? That decline rate may change. So it's not, the decline rate is not constant. The decline rate can change over time. So you may start with sharp decline rate, specifically for unconventionals, and then gradually as time goes on, you see the decline rate gradually, flattens or decreases. So that's why we need to characterize, we need to understand the behavior of decline rate. And that behavior, the changes of decline versus time is determined by a factor which we call it B factor in the reserve evaluation. So B factor tells you how the decline rate changes versus time. The change of decline rate is determined by the B factor. So we need to know two important things for decline curve analysis. First, decline rate that tell you how the rate declines over a time period. And secondly, B factor, which tells you how the decline rate changes versus time. So we need to know those two parameters in order to be able to, make decline curve analysis and use it for a well. So when we know those two factors, decline rate and B factor, we can use an equation, okay, to predict the forecast in the future. This is the most commonly used equations, they call it ARP equation, and this one is called hyperbolic decline. So what it tells you production at any time, this is your rate, is a function of your initial production divided by 1 plus decline rate, initial decline rate multiplied by time to the power of 1 over B factor, or the parameter that characterizes your decline rate change. That's very simple equation. So in order to perform decline curve analysis, what you need to do, you need to see what value for QI, DI, and B you can pick in order to give you the best fit. You need to fit a curve through this data. The curve is determined by this equation. So your job is to tune DI, B, and QI in order to have the best fit. When you have the best fit, use this equation, put time equal to, any value, 20 months, 30 months, 20 years, 30 years, and at each time, you will be able to calculate the rate. So this is called hyperbolic decline, and we are going to show you how you can tune some of these parameters. And the other thing is, if the decline is constant, if it doesn't change. You call it exponential decline. In that case, B value is 0. So when the B value is 0 and the decline doesn't change over time, we call it exponential decline. If B value is equal to 1, we call it, harmonic decline. So there are 3 types of, decline. Hyperbolic decline, which is the general form you are seeing in this equation. Exponential decline when the B value is 0 and D is constant. And harmonic decline when B is equal to 1. There are wide variety of, decline curve equations, specifically for unconventionals. We don't show it here. So this is the most commonly used, but if you want to get more information, you can go and search, what other decline curve analysis are typically applied for unconventional wells, multi-segments, Young. There are some other, stretched exponential. These are, some other decline curve, but let's mainly focus on this equation. And then let's talk a little bit about that B factor, how the decline rate changes over time. So that B factor or B value is function of your drive mechanisms, or the mechanism that is in charge of the fluid flow in the porous media. So if the reservoir is weak, if you don't have enough pressure support, you will see, your production declining at high rates. The decline remain constant. So you see a B value equal to 0. What are the cases, for example, for high pressure gas, for single phase liquid production? Sometimes, when we have tubing or restricted gas production or poor water flood performance, you see the high decline rate and it remains constant. However, as you help, your reservoir is assisted by something, energy support, you see that B value increases and your decline gradually decreases. You don't see sharp drop in your oil production. For example, you see when we have solution gas drive, or when we are dealing with the typical gas wells, when we have water drive that supports the oil production supports the oil flow into the reservoir. You see, if we have some sort of support, that B value gradually increases and we see lower value in the production decline in the future. So that was an introduction about asset evaluation techniques and decline curve analysis. Now we are going to see a real case study, how we can perform asset evaluation with decline curve analysis for a gas condensate reservoir. Okay. Probably I need to, do you see my screen or I need to share it again?
Yes, we do.
So do you see many wells?
Yes, we do. Yes.
Okay, awesome. So what we have here, we have an asset of gas condensate wells with gas condensate wells. You can see probably we have more than 120 gas condensate wells, and we are going to evaluate these assets. So what we do first, we perform single well analysis for just one well, and then we evaluate the whole asset together with decline curve analysis. So you see, I want to evaluate gas well number 1, which is located here. So I use IHS Harmony Forecast software to perform this analysis. What we can do, we can select this gas well, we can go to analysis. And before we start any analysis, I just want to show you the production data. We need to use that production data to perform decline curve analysis. Let's see what we have for this specific well. So what you can see here in red, you can see gas rate. In blue, you can see water rate. In green, you are seeing condensate production. And for this specific well, we recorded some average reservoir pressure over time. So these dots are your average reservoir pressures. They are for, you know, material balance that I will talk about it later. So what we are seeing is we are looking at gas rate, water rate, condensate rate, and we want to perform decline curve analysis for this specific well to understand its EUR and then forecast the production in the future. So I go to analysis in IHS forecast software. I click on decline curve. We are dealing with, you know, gas condensate wells, two phases, gas and condensate. We should forecast both of them. Gas is the primary phase in the gas condensate reservoir. So the approach is first, take care of gas, which is very important. And second, take care of condensate, which is a secondary phase. So we select rate versus time. And now you are looking at production rate versus time. And what we can do, we can create a decline curve analysis for these wells. So you remember what we talked about? We talked about two parameters, initial decline and B value. What we can do in this table, we can have access to those parameters. You see, for this well, the QI or the initial decline is here. The initial rate is located here. So the initial rate is 1395 MCFD at this point. The well has the B factor of 1, and the initial decline is 40%, the decline at this point. So what happens is you can tune this parameter. You can make it, for example, 1.2 and see what will happen to the shape of the curve, or you can make it 0.5 and see what happens. So manually, you can tune this parameter until you are happy with the shape of the curve. And you can see whenever you change that B factor, how the shape of this decline curve analysis changes. So let's put it 1. And again, let me show you, what happens if you change your initial decline. It's 40%. I make it 50%. You see, the fit quality is not good. I make it, 30%. And you see, this is the quality of the fit. So what you need to do, you need to play with these two parameters until you are happy with the shape of this fit. This is the workflow. For each individual well, you create the initial fit. And when you have the initial fit, you start tuning B factor and DI and QI, and then you can have a good fit. The other thing is, on this plot, you can tune all of those parameters. For example, you can increase your QI or you can decrease your QI. You can change your initial time here, you can, easily change your initial decline. You see, I am changing the initial decline, and you can also change your B factor. So this is, how I'm changing my B factor. B factor, quantify or characterize the curvature of this fit. See, I'm changing, that B factor here. When you are happy with the quality of the feed, you can calculate the production in future. You are seeing here, this would be the production in the future. And if you add all of these productions together, you can calculate estimated ultimate recovery. So for this gas well, what we are looking at, for 30 years, the forecast starts at, probably end of 2019, and we forecast the well for next 30 years. The estimated ultimate recovery for this well is around, 2.7 BCF of gas. So this, I call it, hyperbolic decline. And I want to show you one thing about, decline curve analysis. So this is hyperbolic decline. I create another decline. And this time, I want to have an exponential decline. We talked about that. For our exponential decline, the B factor is 0. Okay, so this is the exponential decline. Okay, so what you can see, instead of specifically when you are looking at the log of rate versus time, exponential decline is a line. And you can see here, I can have a good fit even with exponential decline. You see, both of these two curves go through my data. And let me tune a little bit my final rate. So both wells end at the same time, okay, after 30 years. So what we are looking at, specifically here, zoom, okay, you can see here visually, okay, both of these exponential decline and the hyperbolic decline, they fit your data. They go through the data. And before I move forward, let's rename it to speed decline. One of them is giving you 2.7 BCF of gas. The other is giving you 1.9 BCF of gas. This is the drawback of the concave analysis. Which one can you rely more? Okay, this question should be answered with some additional information, some additional analysis. So as a reservoir engineer, your job is to come up with most reliable EUR, most probable EUR. Is it 2.7 or is it 1.9? So we should answer that question. We should come up with some techniques to help us decrease the uncertainty. We are seeing around 30% uncertainty, and this will affect the economics of the well. This will affect the estimation that we have for our well performance. Each of these curves needs its own surface facilities. What rate I'm going to produce? This would be my rate. This would be my rate. How much money I'm going to make? This gives you much higher money compared with this trend. So it is very, very important to come up with some sort of, additional techniques to help you narrow down the range of uncertainty. So now our question is, which one is more reliable? I don't know. What I can do is we can get help from recovery factor. And what recovery factor is? Recovery factor is the ratio of your recoverable production to total hydrocarbon in place. Imagine you have 100 millions of barrels of oil in place and you can just produce 20 million barrels. So your recovery factor is 20%. So we are going to get a little bit of help from recovery factor to see what the EUR would be. So what I need to do here, I need to create a new analysis and I need to calculate my original gas in place. And then with the help of recovery factor, I can understand what EUR is more correct. So for this specific well, what we need to identify, we need to identify some geological parameters and PVT parameters. So for this well, let's assume the thickness of the well is 50 feet, the porosity of the reservoir is 6%, the initial gas saturation is 65%, and the water saturation is 35. So these are the parameters that you need to identify to calculate original gas in place, and then you can identify, we can get some help from recovery factor. So the main or one of the most uncertain parameters in order to calculate the gas in place is the drainage area. How much a well is draining, how much is the area that a well is draining from. This question would be answered with different techniques, but now let's assume the drainage area for this specific well is 240 acres. And now, based on all of these parameters, I can see that the original gas in place for this specific well is 6 BCF of gas. Let me rename this analysis to volumetric. Now, we have two different EURs. Let's go back to our analysis. We have one EUR equal to 2.7 BCF, one EUR equal to 1.9, and we want to know which one might be more reliable. So what I do, I connect my volumetric with my hyperbolic decline, and I connect my volumetric with exponential decline. So for the exponential decline, we see the recovery factor is 31% based on our volumetric calculation and EUR estimation. For hyperbolic decline, the recovery factor is 44%. For exponential decline, the recovery factor is 31%. For these specific assets, we should have an understanding of recovery factors. And there are some techniques, specifically with the use of numerical modeling and simulation, you can estimate the recovery factor for that region, for that area, for that asset. Then you can use that recovery factor and this guides you what EUR you may get. So in this region, we assume or we can tell that the recovery factor would be around, 35% to, 45%. This is unconventional gas condensate reservoir. So if the recovery is between 35 and 45, that tells you, okay, this hyperbolic decline is more reliable. This is something that you can use for your studies and asset evaluation. So with the help of volumetric, gas volumetric, you can understand which decline curve analysis you can use. But let's get back to our gas volumetric. The question here is, what is the drainage area? Do we know that? Typically, the drainage area can be calculated depending on the spacing between the wells, how far the wells are located from each other, and then you can use that spacing. But this is not something, reliable. The drainage area may be beyond or above your well spacing. What we can do, we can perform flowing material balance to estimate our original gas in place. So I click on material balance, gas material balance. And then before we move forward, just I give you a little bit of explanation of what material balance, gas material balance is. So when we are dealing with some productions, throughout our production, sometimes, people shut in the well, they wait, and they measure what would be the average reservoir pressure. Wait, 1 or 2 days, depending on the permeability of the formation, until they see the enough build up and they can measure the average reservoir pressure. Then they continue producing and they repeat these tests every 6 months, every 4 months, every, year. So you can see throughout the year, we have measured variable average reservoir pressure. So this is how the test is done. Every 6 months, shut in the well, measure the average reservoir pressure. And then if you plot P over Z, average reservoir pressure divided by your compressibility factor or Z factor, and plot it versus cumulative gas production, if you extrapolate that, you'll be able to get your original gas in place. And now I'm going to do that. Here you can see my P over Z values versus cumulative gas production. Here I click, create a gas material balance. And then you can see this line is created, it's extrapolated. And here when it crosses the y-axis, it tells me how much my original gas in place is. So I rename this analysis to material balance. And here you can see we estimated our original gas in place to be 6.2 BCF. There is uncertainty associated with that. How we can understand more realistically what the contacted area is by flowing material balance, because flowing material balance tells you how the reservoir is behaving, how much is your total drainage area, because these pressure signals are coming from the whole reservoir. So by flowing by material balance, you can tell that your original gas in place is 5.6 BCF. And you can also determine how much your drainage area is. This is mainly done for conventional reservoirs. If you are dealing with unconventional reservoirs, you should perform flowing material balance that will be explained next week by James York. So these are different analyses that we did in order to understand how much our estimated gas recovery is for these wells. So EUR for the gas. We calculated EUR for gas. Now we should deal with condensate recovery, how much condensate we are going to produce. So exactly the same as, you know, gas phase, we can perform decline curve analysis for condensate. So you can click on decline, condensate rate versus time. We are looking at condensate rate versus time, and then we can have a condensate decline. You can see the decline curve analysis, and I, you know, rename it to condensate decline. However, when we are dealing with the hydrocarbon systems that includes two different hydrocarbon phases, oil and gas, gas and condensate, the general workflow is you perform decline curve analysis for your primary phase, in this case is gas, and then instead of forecasting the secondary phase with decline curve analysis, you perform something which is called ratio forecasting. So ratios are changing in a more, you can characterize the change of the ratios easier compared with decline curve analysis. And I show you, how you can do that. So instead of forecasting the condensate directly, we are going to forecast the condensate over gas ratio, and then we are going to combine condensate over gas ratio with the gas forecast that we have to forecast the production of condensate. So I go here, this time I select gas rate versus time and condensate to gas ratio. And here what I'm going to show you, let me clean this plot a little bit. What you are seeing here, we are looking this green dotted line or dashed line is condensate to gas ratio, how much condensate per unit of gas we are producing instead of condensate production. Here, this green line is your actual condensate rate. But what we do, we divide this condensate rate by gas rate, and we come up with condensate to gas ratio. Look here, we see two different distinct trends in our condensate to gas ratio, and easily we can characterize those trends. Instead of hyperbolic trend, we see a straight line trend. It's easier compared with hyperbolic, so we can capture this behavior much easier. So I click on this condensate to gas ratio trend, and I try to capture this trend. You see, we are seeing probably 3 segments of condensate to gas ratio versus time. So I select this one. This is my first segment. The condensate to gas ratio decreases from 80 to 65 barrel per MCF. I add a second segment. Then during this time, my condensate to gas ratio drops in this fashion. And finally, I will add the third segment, and you can see condensate to gas ratio is more or less constant during 2017, 2018, and 2019, and it will remain constant throughout the life of the well. So now what I have a condensate to gas ratio trend. What we want to do here is, what we have a hyperbolic gas trend. You can see here, we put a decline curve analysis for gas. What I do, I connect my condensate to gas ratio trend with my hyperbolic decline. We are going to multiply this condensate to gas ratio by the gas rate, and we can calculate the condensate rate. So now, if I combine these two analyses, I can go to my hyperbolic decline, and I can see how much condensate I'm going to produce in the future by combining, condensate to gas ratio trend with my gas forecast. So you can see this is the different way to predict the condensate production in the future. So we are done with single well analysis. So for each individual well that you have in this asset, you need to perform these analysis. So what you can do, you can save this workflow and then you can apply it for all of the wells, 100, probably 120 wells that you have in this asset. And then each individual well performance should be quality check. Okay, you should have a nice gas decline curve analysis, a good volumetric, a good condensate curve, and then you are done with single well reserve evaluation. Now, the question is, in this asset, you see there are some undeveloped areas. Look here, we are going to drill a new well in that region. The main question is how much that new well is going to produce. So as part of your asset evaluation, you should understand the performance of the new wells that you are going to drill in the undeveloped areas of your reservoir, of your asset. If I drill here at this location, if I drill here, if I drill here, how much would be the production of that well? And this is done with something which we call type wells, or some operators, they call it type curve. But the actual wording is type well, and I'm going to show you how we can use type well to forecast the performance of the new well that we are going to drill, for example, here. We are dealing with the gas condensate reservoir, and let me show you one thing. I go to diagnostics that plot the performance of different dynamic parameters versus time. I deselect everything. I select normalized time, and then I select condensate to gas ratio. And the other thing that I do, I select all the wells that I have in my condensate asset. So what you are seeing here, you are looking at condensate to gas ratio versus time for all of these wells. So condensate to gas ratio actually tells you how much condensate your well is producing, too much condensate or small amount of condensate. This is the function of your gas condensate PVT properties, or composition of your hydrocarbon. So we are dealing with two different regions in our reservoir. Lean condensate region that produces low amount of condensate. You can see they are at the bottom of this line, and high or rich condensate region that, let me have this plot in the coordinate Excel. So these wells are typically, produce low amount of condensate. These wells are producing high amount of condensate. They represent different behavior, different characteristics. So what we do, I go to the map, and what I am going to plot for you, I'm going to create a bubble plot that tells you how much your initial condensate to gas ratio is. You can see we are seeing two different behaviors. The wells that are located in the north and northwest of our asset, they are showing a condensate, condensate ratio below 166, below 170. And the wells that are located in the south and southeast, they are showing a condensate yield of 300 barrel per MCF. So you can see we are dealing with an asset with different behavior, different characteristics. So in order to predict the performance of a new well that we are going to drill in each region, we should look at the behavior of the wells around that undeveloped area, because the new well that we are going to drill there would behave similar to the adjacent wells. So this is type well. So what we can do, we can group these wells. So I select all of these wells with low condensate yield, with low condensate production, and I place them in a group that I call it lean condensate. And the wells that are showing higher condensate production or higher condensate to gas ratio, I call it rich condensate wells. Now you can create a type well for each of these regions. And type well is actually the average performance of all of these wells. It's very easy. You want to know what would be the performance of the new well that you are going to drill here. So you take the average of the performance of all of these wells with the similar characteristics and the similar behavior. So how we can make a type well? As I told you, we should look at the average performance of the production of all of these wells with the similar characteristics. So I go within the IHS Harmony Forecast software, I select the lean condensate group that I created, and you can see under this group, all of these wells are located. I go there, I go to analysis, and this time we should create a type well. I click on the type well, rate, and the first thing, my primary phase is gas. So I want to create a type well for gas. I create gas, I click on gas, and now let me make this color all gray. Let's see what we are looking at. In this plot, we are looking at performance or rate, gas rate of each individual well within the asset that we selected, the lean condensate area, the asset in the northwest of our total condensate reservoir. So we are looking at the production performance of each individual well, and this red line is the average of all of these wells. So you can see how the average behaves. So what I really want to do first, I typically want to get rid of this cleanup period. When you open your well, when your well wants to come onto production, it produces a little bit of, water because these wells hydraulically fracture. So some people want to get rid of this cleanup period. So I go here and I start the rate at the peak rate. So we are looking at, average trend of gas rate versus time for around probably 60 wells. And what I can do here, I can create, these two. I create a gas decline curve analysis for this specific trend. So you can see here now we are having a gas decline curve analysis for the average trend. So if we are going to drill a new well in that region, the well we believe will produce with this trend, since it is the average of all the adjacent well to that undeveloped area. So I call it, gas type well. And we need to do the same thing for our condensate, because this well is going to produce both condensate and gas. So what I do, I create a new analysis. This time I go type well, and I go with condensate to gas ratio. And I create again a type well for condensate to gas ratio. Let's make them all gray. What we are looking at this time, we are looking at condensate to gas ratio. Here. Okay, so let's look at condensate to gas ratio in more detail. You can see we probably see one or two trends for condensate to gas ratio. So I click here, condensate to gas ratio. I have two different I can use two different segments. One segments tell me initial condensate is around 120, and it reaches to probably 80 barrel per MMCF within 25 months. And I add a second segment, and you can see here, I may believe this part is not very reliable, and I assume I have two segments. I right click here and I call it condensate gas ratio pipeline. So now I have two different profiles. One profile for gas that I believe this is the average performance of the wells that are located in the lean condensate area. And I have a profile for condensate to gas ratio for the gas that for the wells that are located in the lean condensate area. So what I can do now, I'm going to drill a new well, and I want to see how that new well will perform. So I right click here, I click these two trends on clipboard, and now I'm going to drill a new well. You see here, this is my lean condensate region. I am going to drill a new gas well here at this location, and I want to forecast the production of gas and condensate for this new well that I drill. You see this new well is drilled, typically, you know, people call the new well pod. You know, well, I drill a pod well. I go to the pod well. This is a new well with no production data. So I click on, you know, gas, rate versus time. And this time I can bring the type wells that I created for gas and condensate. You know, now if you click here, you can see this new well will have this gas trend or gas production. I will copy my condensate to gas ratio there, and I will select my condensate rate. And this well is going to produce this amount of condensate. So gas EUR would be around 5 BCF and condensate EUR would be around 452,000 barrels of condensate. So this would be the performance of the new well that you are going to drill in that specific region. So the well that we drilled in this location is going to produce this amount of gas and is going to produce this amount of condensate. At the end, we want to see how much money we are going to make for drilling this new well. Does it worth to drill this new well, and how much money we can make? I can go to the economics part and let's assign some economical parameters to this well to calculate the total money that we are going to make and, you know, rate of return. So I add a new case. So for your net present value calculations, you need to first assign a value for your discount rate. Our discount rate is 10%. Then you need to bring in some gas and condensate forecasts. You remember, you know, we created a type well for gas. So we bring the gas forecast, and we bring the condensate forecast. The other thing that you need to specify, you know, what is the price of gas. So today I checked, and, you know, the price of gas was around $2.8 per MCF, and the price of condensate was something around, you know, I think West Texas Intermediate was 58, but let's assume the condensate price is $55 per barrel. Now you can see the discounted cumulative periodic cash flow versus time is created. The other thing is we are going to drill and complete this well. We should to come up with the capital expenditure, how much we are going to spend in order to drill and complete this well. So I assume we are going to spend $5 million to drill and complete this well. So we specify this CapEx. Then you need to specify your operating cost for this specific well. We define two different operating costs. First is monthly operating cost, and second is your variable operating cost, which is function of how much gas and condensate you produce. So for the case that we are dealing with fixed operating cost, we assume $2,000 per month, and then we add one more cost, which is, you know, your gas processing cost. We assume it is, you know, $1.8 per MCF of gas. This is how much you spend to process your gas, and then you need to process your condensate. So we select, you know, $1 per barrel of condensate, and it's around, you know, $2 per barrel of condensate. And finally, I think we are good to go here. We specified all the costs that we wanted. The last thing is tax. So we assume 4% severance tax for both gas and condensate. And at the end of the day, you can tell if you go and spend $5 million to drill that well in the region that I showed you, you are going to make $12 million in 30 years. So this is your net present value, how much money you are going to gain based on these capital expenditure, oil and gas price, operating costs, and taxes. And I think we went through everything. Just I summarize, what we did. For this specific gas condensate asset, first we perform a decline curve analysis for a single well to come up with the EUR of gas, EUR of condensate. So we performed decline curve analysis, we estimated the EUR, then we performed gas volumetric to calculate recovery factor, and based on recovery factor, narrow down the range of uncertainty. Then we perform gas material balance to understand how much total gas in place we have. And finally, we forecasted the condensate production based on gas rate and condensate to gas ratio. Then what we wanted to do, we wanted to understand what will happen if we drill a new well in the undeveloped area. So what we did, we divided this region into two different type well area, lean condensate and rich condensate. For the lean condensate, we created a type well by looking at the average performance of multiple wells. You see, we are looking at the average performance of the multiple wells. We created a decline curve analysis for both gas and condensate to gas ratio. And then we use these parameters in order to estimate the economic of the well that we are going to drill in this region. And you can see after drilling that well, you are going to gain this amount of money. So I think we are done with asset evaluation for a gas condensate region. And now I'll be happy to answer any question that you have.
Thank you so much for this extremely insightful and informative session. And now I would like to pursue with a question of our audience. Could you explain, please, how can we consider the condensation process while modeling a gas condensate reservoir? Is there any special equation or steps we should do to take this process into consideration?
Sure. So gas condensate reservoir modeling is probably one of the most complex cases that we deal with in oil and gas industry. So in order to really talk about condensation of gas and how much condensate we produce, we should use, two curves that we call it liquid dropout. So liquid dropout tells you how much condensate you are going to produce at each specific pressure. So if you are above the dew point or below the dew point in the gas condensate reservoir, this really affects your condensate production. So if you are above the dew point, you can bring the gas to the surface, and in the surface you decrease the pressure and you are going to produce a lot of condensate. If you are below if your reservoir gets below the dew point, you form some condensate in the reservoir and you leave some condensate in the reservoir, and probably you bring some different gas composition to the surface and you recover less condensate. So in order to be able to model this process, you need to consider, liquid dropout curve. You need to have a reservoir model that tells you what is the pressure at each time during the performance of the well, and then you'll be able to model the condensation process.
Thank you so much for answering the question. The next question is about what's the difference between rate transit analysis and decline curve analysis?
Okay, thank you for your question. That's a great question. So with decline curve analysis, you just fit a curve through production data and extrapolate it. That's it. You don't understand your reservoir. You cannot characterize your reservoir. For example, you want to understand how much is your contacted area. With decline curve analysis, you cannot do that. You want to understand how much is the permeability of the formation. With decline curve analysis, you cannot do that. With rate transient analysis, you are looking at rate and pressure together. Pressure is the reservoir signal. Reservoir is talking to you with pressure. You can analyze rate and pressure together, and with rate transient analysis, not only you are able to forecast the production, but also you'll be able to characterize your well and reservoir system, and you can get something, informative regarding to your reservoir properties and well properties.
Thanks a lot. Another question is about what if the well is not produced continuously, which the well is shut in for some time, for example, shut in during one year? Can we use decline curve analysis? How to determine production value for shut-in well if we want to create forecast production?
That's a great question. So when the well is shut in, you go through a process that reservoir pressure in the vicinity of your well gradually increases. You experience a buildup, and when you open the well again, you see something which is called flush production. So increase in your rate, and then that rate drops immediately. For a single well analysis, to answer you, no. With decline curve analysis, you cannot accurately predict the performance of the well after shut-in. Either you need to look at the analogous wells and see how they perform after shut-in with the similar shut-in period, or assume something for after shut-in performance, or you need to do a little bit more in-depth analysis. You need to build a numerical simulation model. You will shut in the well, see the build-up in the pressure, and then when you bring the back onto production, you see the flush production effect, and you'll be modeling accurate.
Thanks a lot. And final question is, what are the sudden spike and dips in decline curve graphs? Does it affect the quality of our evaluation?
Sorry, what was the first part of the question?
What are the sudden spike and dips in decline curve graphs?
Okay. Yes, so these are typically some operational issues. Okay, so if you see a spike in the rate, or a sudden drop in the rate, this is not something your reservoir is doing. Probably something happened in your processing or operation system. You shut in the well, you have some workover or something like that. You typically don't consider those data points in your decline curve analysis. You filter them out, and then you perform decline curve analysis with the dots that you can see, with the points that they are following the same trends. Those are some noises, those are some outliers, and typically we try not to consider them for decline curve analysis.
Thanks a lot for answering our questions with special attention. And I think it's the end of this session. We hope we shall see you in our next session as well.